Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Amazon stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Amazon is an e-commerce and cloud computing company. It has been referred to as one of the most influential economic and cultural forces in the world. The company is headquartered in Seattle, Washington, and was founded in 1994. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Zicha, Vienna, Swiss, Sao Paulo, Buenos Aires, Bulgaria, Colombia, Santiago, Kazakhstan, Lima, Italian Bourse, and NEO Stock Exchange. Let's get started with the model. This is a large cap company, 1.1 trillion market cap. They're trading at $2,200 a share, and they have 509 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have lots of free cash flow in 2019 and 2020, but it is negative in 2021 and the trailing 12 months. They're investing a lot back into their business through CapEx, but they are generating positive operating cash flow. I'll show you later when we look at their statement of cash flows. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that tripled from 2019 to 2021. It did dip from 2021 to the trailing 12 months down to 21.4 billion. Revenue is the sales for the company, and that goes up from 281 billion to 478 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was over 64 billion in the trailing 12 months, a little lower than 2021. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. That's almost 20 billion, down from 25 billion in 2021. They received 450 million of interest on their investments and paid 1.9 billion of interest on their debt. Then other income and expenses. These are all the gains or losses not part of the company's core operations. They had a gain of over 4 billion. Then your pre-tax income, your taxes, their earnings from investments in other companies. And the bottom line of the income statement is their net income, which doubled from 2019 to the trailing 12 months, but down from 2021. This is their most recent income statement from their 10Q. In the first quarter of 2022, their revenue was 116 billion, up from 109 billion. 56 billion from product sales, 60 billion from services. Here's a breakdown of their revenue. 51 billion from their online store, 4.6 billion from their physical locations, 25 billion from third-party sellers. Every time something is sold on their platform, they receive a commission. Subscriptions of 8.4 billion, advertising of close to 8 billion, their cloud platform over 18 billion, and 660 million of other. They control about 1/3 of the cloud computing business. Microsoft is second and Google is third. Here's a breakdown of their expenses. 66 billion from cost of sales, 20 billion from fulfillment, 15 billion in technology fees, 8 billion in marketing, 2.5 billion of G&A. So their operating income is down from 8.9 billion to 3.7 billion. And they had a big negative in other income and expenses. This is due to an asset impairment. So they had a net loss in the first quarter of 2022 of 3.8 billion. Last year was a gain of 8.1 billion. So their loss per share is 756. Last year they had a gain of $16. Their shares outstanding are up a little bit from 504 million to 509 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They generated the most in 2020, over 66 billion. The trailing 12 months is higher than 2019, but they're investing a ton back into their business, 63 billion in the trailing 12 months, which is a lot more than 2019. So they have negative free cash flow in the trailing 12 months of 25 billion. Hopefully the investment in CapEx leads to greater cash flow in the future. So they did add a lot of debt in the trailing 12 months. They added 39 billion, paid down 24 billion. So they increased their debt load about 15 billion. Let's look at the capital structure. 134 billion of equity, 113 billion of debt. They have 54% equity, 46% debt. And if they used all the cash on their balance sheet to pay down some of their debt, they would only have 47 billion of debt left over. And this is their capital structure since 2015. The dark blue line is their equity balance, which you can see goes up a lot. Their debt also goes up, but their equity is going up a lot faster than their debt, because you can see it was pretty similar in 2015. Now their equity is much higher, and you can see they keep a lot of cash on their balance sheet at any given time. That's the green line, the cash balance. I used the lowest WACC on Finbox, 7.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.1 trillion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $980 billion. We divide that by 509 million shares. And we get a calculated stock price of $19.25. They're trading at $22.19, so they're trading at a 15% premium. It's a sell according to the model. Last time I did a video on Amazon was about a year and a half ago. They were trading at $3,200. My target was $2,900, and you can see they came down a lot since my target, down to $2,200. And they still seem overvalued. The company's revenue target in 2024 is $710 billion. In 2023, it's $615 billion. In 2022, it's $526 billion. And I continue this growth into 2025, and I got $806 billion. That's how I got their future revenue estimates. On average in 2019 and 2020, they converted 7% of their revenue into free cash flow. So I multiplied their future revenue estimates by 7%. That's how I got their future free cash flows. The website Simply Wall Street is a lot higher than me. They're at 5,200. They're saying the stock is 59% undervalued. 36 analysts priced this stock, and the average price target is 3,600. The low is 2,800, the high is 4,200. This is where the stock has been trading the last 5 years. So 5 years ago was about $1,100 a share. Then it almost hit 4,000 a few months ago. Then it's really struggled the past few months. Their last quarterly earnings were pretty weak, plus this terrible bear market. So it's trading at a huge discount relative to its 52-week high. They have a beta of 1.2, so the stock moves a little more than the market. It's gone down 34% in the past 52 weeks, while the S&P is down 5%. The 52-week low is 2,000. The high is 3,800. And the stock is trading below its 50-day and 200-day moving average. 4 to 5 million shares are traded each day on this stock. Of the 509 million shares outstanding, 458 million are on float. 61% are held by institutions, and 1% of the shares are shorted. They've done 3 stock splits in the 90s, a 2-for-1 in 98, a 3-for-1 in 99, and a 2-for-1 in 99. If you put $10,000 into this company 10 years ago, you'd have over $100,000 today. That's a 920% return, a 26% annual return. The CEO's salary is only $175,000. But their total compensation package is well over $200 million. 60% of the company is held by institutions, 30% by the general public, and 9% by individual insiders. They employ more people than any public company, and I believe it's more than any company in the world. They have 1.6 million workers. The great Jeff Bezos owns 10% of the company. His valuation is over $100 billion, then Vanguard, BlackRock, State Street, and T. Rowe Price. Let's look at their financial ratios. Their PE is a bit high at 53, that's stock price over earnings per share. The market median is 20, the average is 30. Price to sales is good at 2.4, that's stock price over sales per share. Price to book of 8.4, and we cannot look at the price to free cash flow since they have negative free cash flow. They have a decent return on invested capital of 9%. They can cover their interest payments over 10 times. An ROE of 16%, which is better than a market median and a market average. Their current ratio is slightly below 1, that's current assets over current liabilities. Quick ratio is 0.7. They had negative $25 billion of free cash flow in the trailing 12 months, and they have negative $5.6 billion of working capital. So it looks like they're going to be short $30 billion, so they're probably going to need to add some debt over the next 12 months. The best way to look at ratios to compare them to companies in the same industry. There are 50 companies in the same industry as Amazon, And if Amazon has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend a ton of money in CapEx, a lot more than every other company. They have a good debt to equity ratio, better than average. They don't pay a dividend like most companies in this industry. They have a big negative in free cash flow. They're the largest company in this industry. Their price to book is a little worse than average. Price to earnings a lot worse than average. We cannot look at their price to free cash flow. And their price to sales is also worse than average. They generate a ton of revenue. Their 5-year annual revenue growth rate is 27%, which is average. That's still really impressive when you have so much revenue coming in. To grow it at 27% is not easy. And they have a good ROA and ROE. So to summarize, I have them trading at a 15% premium, but this company's a juggernaut. It just keeps growing and growing and getting into different industries. For a long-term hold, I really don't think you can go wrong. In the short term, anything can be volatile, but in the long term, things smooth out. I rank their free cash flows 3 out of 10, their revenue 8 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.